Okay, so again, thank you so much for joining us today to discuss how you can protect your future, yourself, your family, your property. And just recapping again that I am a estate planning and trust administration attorney at Ligerlof. I graduated from Pepperdine School of Law. I most recently published an article with the California State Bar on estate planning for recent Latino immigrants and sort of the special tax consideration and family planning issues that they often encounter. And I'm also a volunteer attorney advisor for the Planned Giving Department of the Catholic Archdiocese of Los Angeles. So one day I'm in Palmdale, another day I'm in Glendora. So I often travel around to different clients, and it's something that I enjoy. So to get into estate planning, what are the goals of creating an estate plan? So first and foremost, it's really to provide for your loved ones. A question that I get often is, why should I create an estate plan? I'm going to be dead. It's not my problem. They can figure it out. It's not something that I benefit from. And that's essentially true. Most of what this is really to protect your loved ones, to protect your children, to make sure that they are provided for when you're no longer here, and to make the transition as smooth for them as possible. Sometimes when we don't make our own decisions, our children are left to make those decisions, and our children don't always agree with each other on what you would have wanted. So it's really just to protect them and make it as easy of a transition for them as possible. And another is to protect minor children and special needs children. So for minor children, as part of an estate plan, you can prepare guardianship documents, and that's something that I can help you do. And with guardianship, you name someone you trust to take your children and to take care of them if you're not able or if you're no longer here. And that is an important part of creating an estate plan. And another is for special needs children or special needs beneficiaries. There is a law that says special needs people who are receiving government benefits cannot have more than $2,000 of their own assets. So oftentimes what people will do when they create an estate plan is they will disinherit their special needs child because they don't want that child to receive a large sum of money and then be disqualified from government benefits. But disinheriting is not really what we want to do a lot of times. So with an estate plan, we can structure the inheritance in a special way so that your child can still receive that money and all of it without disqualifying them from receiving the benefits, which means that that money won't count towards that $2,000 cap. So I'll discuss that a little bit more in a bit. And another benefit of creating an estate plan is to prepare for health emergencies and incapacity. So this is where an estate plan really benefits you now while you're alive. And it's really to prepare documents so that way if you are, God forbid, in an accident, an emergency comes up and you can't make your own healthcare decisions or manage your own affairs, you've already pre-selected someone who you trust to do that for you. Because if we don't do it ahead of time, we have to go to court and ask a judge to pick someone. And that takes a lot of time and it's very expensive. So we can avoid all of that by preparing the right documents now. And again, going back to court, we want to prevent court intervention by preparing an estate plan. When I discuss probate and explain probate court with a lot of my family and friends, they're always shocked by what probate court is. I'm starting to learn that it's California's best kept secret. Most people don't know about it. I certainly didn't know about it until I started studying estate planning in law school. So I'll be describing that process to you, and hopefully we can avoid that. And another goal is to reduce your taxes. So there are estate taxes, death taxes is what a lot of people call them. And right now we have exemptions that allow for single people who have less than 11.58 million. They will not be subject to estate taxes, and that's double that for married couples. So that covers most of us. Most of us are well under that amount. But that number goes up and down depending on the times, depending on the administration. That could always change. So it's smart to have an estate plan in place where we can prepare. Back in the 90s, that 11.58 million was only 600,000. So we create a plan so that way, if it goes up or if it goes down, you're protected as much as possible. And then there are also other other taxes that come up that we can help you reduce or avoid sort of getting trapped into paying. And that would be kind of like capital gains taxes and property taxes, things like that. So what is an estate? Many people hear the word estate and they think fancy and it's for rich people, and I'm not a millionaire, so I don't need an estate. But an estate is really everything that you have. It's your home, your bank accounts, your personal items like your clothing. It doesn't matter how much it's worth or how much it's not worth, because when you pass away, you have people who love you, and even the smallest items will become priceless to them. They're going to want your glasses, your cookbook, the tea set. For example, my father has a 1972 El Camino Super Sport, and he loves that car. And he works so hard. He works 6 to 7 days a week, 12-hour days, and he doesn't even get to drive it, but it makes him so happy to see it in the driveway. And my sister and I are not car people, so we don't have that same attachment to the car, but I know that when he's no longer here, we're really going to want it. And it doesn't matter that it doesn't really have a whole lot of resale value. I don't think we can get more than $5,000 for it. So it's not life-changing money, but it will be worth so much more to us at that time. We're going to want to go cruising in it, as my dad says, and feel close to him when he's no longer here. So I guarantee that, even if you don't have $1 million estate, you have loved ones who will feel that way about things that you have. And then, of course, it includes things like life insurance, your retirement accounts, and businesses. Estate planning documents. So what an estate plan is it's really a big binder, and it's comprised of these 4 documents. I'm sorry, are you all hearing that dinging, or is it just, you're not hearing it? Okay, good. Just being sure. I'm hearing dinging, and I want to make sure you're not all hearing it. So
No, I do hear that dinging.
Oh, you do hear it? Okay,
Yeah.
sorry, one moment.
I don't know what that. I was hoping that it wasn't my computer.
I'm so sorry to pause this. One moment. I'm not sure how to pause the screen share. I just want to exit out of my.
You could probably just mute the sound on your computer.
Messages. Sorry. Okay. Okay, we're back. So, oops. So sorry. So an estate plan, a lot of people can't visualize it. I know I myself didn't see an actual estate plan until I started working in an estate planning law firm. So it's a big binder, and then you get a lot of documents inside of it. And 4 of those biggest documents would be a will, a trust, an advanced healthcare directive, and a financial power of attorney. So you'll get a lot of other smaller documents as well, but those are the 4 big ones. And I will discuss all of those with you momentarily. So to begin, there are really 3 places where your estate plan can go. Where your wealth can go. So the first is your family, and we have charity, and we have the government. So hopefully more towards your family and charity, as we all feel like we've given enough to government, especially at the point when we are older and passing away. So with the first one, family, distributions to your family when you pass are not automatic. They don't just receive everything right away. A lot of times people think, well, when I pass, my kids they'll just get it. It's automatic, but it's really not. They have to go to court, and that's called probate court. And I'll talk about that more in a little bit, but it's not an automatic thing. But there are people who are already listed out in the law who will get it. There's sort of a list of priorities. So I'm not married, I don't have children, so it would go to my parents, and that they're already in the law to receive it first. And if they already passed at that time, it'll go to my sister. And so that's kind of the way that it works. It's already structured out for you. So for some of us, our parents getting it, like for myself, that's what I would want anyway, that's great. But not for everyone. Some people don't want their estates to go to their parents. Maybe they don't really know their parents, they're not close to them, or their parents don't need it and someone else would need it more. So a famous example for that would be James Dean. So when James Dean died, the famous actor, he was about 24 years old, was already very wealthy, and he passed away without children, without a wife, and his mother had passed. So it goes to probate court, and a judge looks at the statute and it says, no wife, no children. We're going to give it to the father because the mother's not here. So the James Dean father received his entire estate. But the truth of the matter is that James Dean father abandoned him when he was born. So James Dean's father never knew him. They never knew each other. They never had a relationship, but it didn't matter because he didn't create an estate plan where he says, I want it to go to this person. And so it goes to probate court and they just follow the law. And it doesn't matter what the personal particulars are. The father was next, the father was alive, so the father took everything. So next is charity. In that list that I talked about where it says your parents and then a sibling, people are already predetermined, charities are not on that list. So there's no sort of automatic distribution to charities. If you ever want to leave to charity, you have to be very intentional about it and make sure that you really get it into your estate plan and make it clear. Another famous example would be Marilyn Monroe, the famous actress. When she passed away, she created a will and she gave everything to her acting coach. And then she asked her acting coach in private, she said, I'm leaving you everything, but promise me that you'll give everything to charity. Promise me that you'll do this. So he promises her. And I give you one guess what he did or what he didn't do. He did not give any of it to charity. He kept all of it. And he got married and had children of his own. And to this day, that same family is still receiving the money that's generated each year from Marilyn Monroe's image and likeness. And I believe it still makes about $1 million a year. So that family is still receiving that money. And none of it went to charity because it wasn't in her will. She'd only asked her friend to do the right thing and he was not legally required to because it was just a private promise. It wasn't in the document. So we have to be very careful that we make your intentions clear and that it's written out in the documents. And then third is the government. So obviously through the estate taxes and different forms of taxes that I discussed, but even more importantly, probate fees. And that's another way that your money will go to the state of California and to the government. So we hope we can help you avoid probate fees as well. So at a basic level, you have about 3 estate planning options. The first is what James Dean did. He did nothing. So you can do nothing, and that's called probate, and it goes to court in front of a judge. And that's why I have the picture of the judge with the gavel. And then another option is to create a will, a last will and testament. This is the most popular document that you hear about. It is in all the movies and all the TV shows, but there's still a gavel in that picture, and I'll explain why. And then there's the trust. And I like to picture it as sort of like a wallet. So I'll explain all this to you. So estate planning option number 1 is the DoNothing Plan. And that means that you go to probate court because you died intestate, which means you died without creating a plan. And what happens is if you pass away without ever preparing an estate plan, your loved ones have to go to court and ask a judge to get it. And they typically have to hire an attorney to help them do this because it's not something that's very easy to figure out on your own. So they're hiring an attorney, they're paying court fees, and it gets very expensive. And the fees for probate are based on a percentage of the value of your assets. So what we typically see is around 10% of the value of the asset that's going through court. So if we say you have just a home and your home is worth $500,000, and we take 10% of that, that will be easily $50,000 in probate fees just to get that home through the court process and to your children. And that's money that could have, if you had created an estate plan, could have gone to them automatically. So it's very expensive to go to probate court and it's very time consuming, especially in LA County. There are so many people here and we all have to wait our turn, and there's the judges, you know, God bless them, are doing the best they can, but there are only so many judges. So it takes a long time. We're seeing about 2 to 3 years in LA County for a simple probate. And then I've seen it go up to 5 for more complicated ones. So it's very time consuming. And then it's also public because it's taking place in court and these are all public matters. So anyone can go in, sit in on your case, find out who you were, who your beneficiaries are, and what they're receiving. And what we have seen in the past is that people do this kind of like for a living, and they want to know if there are any minors who are receiving money, and then they try to take advantage of those minors. So by creating an estate plan, you're avoiding, you know, the time that goes into probate, what it costs, and you're protecting your loved ones from it having to all be public. When Michael Jackson died, he died with a will, but I'm sorry, with a trust, but he didn't plan it properly. And I'll go over that with you more. But because it wasn't done correctly, he had to go to probate court. And that's why we knew all of his dirty laundry. It was in probate court, so anyone could get access to it. We could see it all. We knew what was going on. We knew who his kids were. We knew what he had, what he owed. So it's all very public. And by avoiding probate court, we keep all of that private. So next we have the second option, and it is a will-based plan. And a will is a document where you can state out who you are, what you have, and who should get it. So it's a very, very basic document. It's typically not more than just a few pages long. And but what most people don't know about preparing a will is that it still goes to court. And that's why I still have a gavel in that picture, is that even if you prepare a fantastic will, it still has to go before a judge. The only time that that's not true, where a will does not have to go to probate court, is if it's considered small by California standards. So what small means is that the real property you own is less than $50,000, which I challenge any of you to have in California, especially Southern California. And your other financial assets have to be less than $150,000 total. So that's including, any life insurance, retirement, if they're not beneficiary designated, bank accounts. So it can easily go over 150. I know most people don't have that in their bank accounts, but when you start adding in things like life insurance and retirement, it can easily go over. So it's very hard to be considered having a small estate. So for the most part, a will still has to go to court, and a judge wants to oversee the process. And another downfall with preparing a will-based plan is that there are fewer planning options. So there's really no way to structure things for your minor children. They kind of just have to get the money at age 18 and they can do with it what they want. Whereas with the trust, you can say they're 18, but I don't want them to get any of it till they're 25. And then another portion at age 30. So there's different ways that you can protect your children from using that money ways that they shouldn't. You can ensure that they are mature when they receive it and safe to receive it. And then there's also no way to plan for special needs beneficiaries in a will. So there's no way to say, I'm going to structure it for them in a certain way so that this money doesn't count towards that $2,000 cap. So with the will, basically, there's not a whole lot you can do with it. It's very simple and doesn't really get you out of probate court unless you have a small estate. And next, my favorite is estate planning option number 3, the trust. It is the gold standard in California. If you have family, minor children, if you have a home, this is really the way that you want to go, and it's with a trust. And the way I like to describe a trust and how it works, because I know it's hard to visualize and understand the way it works, is to picture it as being like your wallet. So your wallet matters to you. It's so important. It's why we immediately panic when we can't locate it, is because it has your cash in it. It has your driver's license with your very personal information on it. It has credit cards. It has your rewards points, coupons, and everything is in there. So, but that's why it's valuable. And now if we were to take all those things out, if you take out the cash, take out your driver's license, and it's empty, it really doesn't matter to you what happens, and it loses all value. And a trust works in the same way. So we create the trust for you, we set it up. But now we still have to get all of your assets inside of it. We have to put your cash in it, your driver's license, your very personal information, your children's information, your credit cards, your home, things like that. We have to get all the assets inside of it. And because it only protects what's inside of it when you die, just like your wallet, it's only going to protect what's inside of it. And so because it does all that for you, it avoids probate court. So if you create a trust and you pick someone ahead of time, this person is called the trustee. So once you pass away, the trustee ensures that everything that you have said in the trust actually happens, because you're not going to be here to do it. So you pick a trustee, and that's typically a child, but it doesn't have to be one of your children. It can be a sibling or anybody that you trust. And this person makes sure that everything happens. And because those things are already set in place, the California courts don't want anything to do with it. They have decided that you've done it all yourself. You already set it ahead of time. You pick someone to take care of it for you. They don't need to get involved. So it avoids probate court if it's done properly, and if you keep getting your assets inside of it. And other great features of the trust is that you can nominate guardians for your minor children. You can give them structured inheritances. So you can say, well, my child is 25, but that's still pretty young. I don't want that child to be able to use that money for whatever they want. So I'm going to nominate my sister to manage that money for my child, and he can use it for education. He can use it to pay his rent while he's in school, but he can't use it to go to Vegas, for example. So you can structure it for your children that way so that it's there for when they need it and what they need it for, but it's not there for them to buy fancy cars and things like that. And it also protects, again, special needs beneficiaries so that they can receive any amount you want to give them. And we structure it in a special type of way, and it will not disqualify them from receiving government benefits. And the next big document in an estate plan is the Advanced Healthcare Directive. So this is another document where you are able to make certain medical decisions ahead of time before an emergency happens. So that way, when an emergency occurs, people already know what your wishes were, and people already know who they can talk to, who can make choices for you. So, for my mother's Advanced Healthcare Directive, for example, I would be the agent. And if anything happened to her, she's in a coma, for example, she can't give permission to receive certain medications or to receive certain operations, but the doctors need to talk to someone. So then they have permission to speak to me, and I can decide for her what procedures she should receive or she shouldn't receive. And another great thing about the Advanced Healthcare Directive is that you can make certain decisions for your children that you might not want to have to leave to your children to decide. And one of those would be end of life decisions. So you can say in your Advanced Healthcare Directive that if everything has been done for me, the doctors have tried it all, I've received every procedure, there's nothing left they can do, and I am passing away, that's just the fact of it, you can say, please allow me to die naturally. If they've done everything they can possibly do, I don't want to be kept forcefully alive through artificial means, let me pass. And this is not assisted suicide, it's not euthanasia, anything like that. It's just saying I'm passing, so please just let me pass. And I've had clients who have said that their parents didn't make that decision ahead of time and they had to decide. And it's been 20 years and they still wonder if they made the right decision, and they're still questioning whether they made the right decision. And it can also cause a lot of siblings, a lot of your children to argue, because one of your children thinks that you would have wanted to stay alive, but another thinks that you wouldn't have wanted to. So by making that decision ahead of time, it's really a great gift that you can give to your children, and it relieves a lot of the burden that they'll have to carry. And another decision you can make in that document is organ donation. So you can say, I want to give my organs for donation, or I don't, and you can limit it to specific uses, such as for study only, or for educational purposes, or transplants, things like that. And the financial power of attorney works just like a advanced healthcare directive, except that it applies to your finances. So it applies in the same type of emergency situations. If you're in an accident and you're in a coma and you can't, go to the bank and pay your bills, you pick someone to do that for you ahead of time. So you select someone who can go to the bank, pull out your money, pay your mortgage, pay that Netflix bill, pay your water bill, pay everything, because you are not in a position to do it yourself. So it's great for emergencies, but not only emergencies, but if you become no longer able to manage your own affairs when you're older. So, oftentimes when you're older, you have plenty of capacity and you know what you're doing, you can take care of yourself, but you no longer feel that you can manage the finances, the numbers anymore. You'd prefer your son to be able to take over. And if he has this financial power of attorney ahead of time, he can do that for you and manage your affairs for you. But once you've lost capacity, you can no longer create this document. So we have to prepare these before you lose capacity so that they're there once you have lost capacity, and your son or whoever you trust can pay your taxes, pay anything that needs to get done. So again, these are the big estate planning documents. We went over really quickly, just a will, a trust, advanced healthcare directive, financial power of attorney. If you have any questions, feel free to email me or text me or send me a message in the box. I'm very happy to answer any questions. And again, the trust functions like a wallet. I help you create that wallet, but we still have to get your assets inside of it. And that's why it's so important to work with a team and people like Brandon Rode and Tony Watson, because I rely heavily on other advisors. I like to work as a team. I'm not a tax expert, so I refer a lot to people like Tony, same with real property and all that implies. I work with people like Brandon, so it's great to have the whole team. So with that, I will pass it off to my next colleague.
All right, Tony, why don't you take it from here?
You got it. All right, let me go ahead and share my screen. Stop the screen sharing. Yes, continue. And go to here. All right, and let's go ahead and hit play. And just want to make sure, is it showing on the full screen on your end?
Yes.
Yes,
Yes,
perfect. All right.
we got it.
Thank you so much for having me today, Brandon. Hey, Ariana, that was a lot of great advice. That whole wallet analogy, that makes complete sense to me. And hopefully everybody really grasped the idea of how that all works, just because when you talk about tax, when I come in with the tax side of things, this is something that is probably, I'm not going to say it's the worst part of my job, but doing taxes for people who have lost a loved one, the upside is when people get married and have children, that's all the fun stuff. But, talking about death, it can be really, really draining for people, especially if it's already happened and they haven't had that mourning period and they're having to deal with finances and dealing with bank accounts and not knowing where assets are. It brings a whole other level of stress to something that's already very stressful. So the one thing that I always suggest to my clients, especially if the conversation comes up with end of life planning, I always say work with a professional, an estate planner, a legal advisor that understands and has good ways of explaining how it all works. That wallet analogy, it makes complete sense to me. Somebody who might not know anything about end of life planning or estates and wills. So that great job. Today, I'm going to talk about, obviously the life, death, and taxes. Everybody's heard that phrase before. Whether you're 6 feet under or 6 feet above, the federal government's going to want to come and collect their fair share of things. So one thing that Robert Hall and Associates, the firm that I work for, I've been working here 15 years. One thing that I've learned very quickly about taxes and business and taxes and obviously death, taxes and marriage and birth and life and all of that, is that they go hand in hand in more than just a couple ways, obviously. And we use a term here at Robert Hall called POP. It's cheesy, but it works. It stands for power of planning. And so much like when you have a business, you got to plan ahead for a lot of major changes and building and capitalizing on really key points in your business. Same thing goes for people who have elderly parents or who unfortunately have contracted a fatal disease, or they're really sick and so they don't know how much longer they have to live. These are things that you need to have a plan in place for, because at the end of the day, when you are gone, when you pass on, the benefit of a lot of this stuff wouldn't really be the benefit for you. It would be the benefit for your loved ones, right? And you don't want to leave them with a mess. You want to leave it to where they are set up and to where things go smoothly and they have the right representatives to work with. And so life, death, and taxes, that saying, even though it's very popular, amongst the accounting world, and then obviously when people talk about estate planning, it's very true that while you're alive, you need to plan. Even after you're passed and gone, you want to make sure that your children don't have to pick up the pieces. You want to make sure that they have the right mourning period to mourn the passing of the loved one. So how do you plan during times of a pandemic, right? I mean, shoot, when this whole thing kind of rolled out, we were hearing these nightmare stories about Italy and how there were thousands and thousands and thousands of people dying. And I can only imagine what their families are going through. And I took a look at my own finances and I just went through my whole wallet and made sure that all of my ducks were in a row. I have a 16-month-old at home, and I want to make sure that if heaven forbid anything happened to me, that my wife and my son are taken care of. And I work in an industry where that's always a concern to me, but even more so, I really want to stress the importance of all of this to my clients, both current and future. So once again, my name is Tony Watson. I work for Robert Hall and Associates. We're based here in Glendale, California. We service a number of tax filings, about 15,000 filings per year. I myself service roughly about 1,200 tax filings per year, anywhere from the 709 forms, gift tax returns, nonprofits, S Corps, C Corps, partnerships, individual tax returns, there isn't a tax filing that I cannot advise on. So hopefully today you're able to take a lot of notes on what I'm going to touch on, and then I'll pass it back over to Brandon at the end here. Just to kind of jump into it and retouch on what Ariana had spoken about earlier, the estate exemption for 2020 is 11.58 million per individual. For a married couple, it's 23 plus million. And the reason why that's really important is because a lot of people think, okay, well, what is going to be the tax on all of my assets that I leave for my heirs? Well, obviously, you have to have pretty significant assets in order to generate any sort of liability. But remember that it's not just the income that you want to worry about and protect in very specific ways, but you also want to know that if you are over these exclusions, what kind of tax rate your heirs are going to pay on all of this money, right? Well, I mean, if you're above 23 million, you have a whole other set of problems, right? Even if you're above 11.58 million, you have a whole other set of problems. But at the end of the day, once again, whether you're paying tax on $100,000, $10,000, or $100 million, tax is tax, right? If you put the proper plan in place, you can reduce liability and eventually pay the obligated tax that you owe and not a penny more than the obligated amount. That's what I've always told clients. If you plan ahead, you'll pay your obligation and not a penny more. And the tax rate for estates above and beyond these numbers can be up to 40%. 40%. This is just the estate tax, right? So you want to make sure that if you do have assets, if you've really worked your whole life to obtain assets over the course of your career, and let's say you've inherited some assets and that puts your estate value for yourself over one of these two thresholds, you want to make sure that you sit down and do some serious estate planning with not only an estate attorney, but also a tax advisor to make sure that if there is any way to reduce any tax obligation, that you do so and not leave it for your heirs. Each year, there's obviously a gifting exclusion amount that you can gift to your heirs, which is up to $15,000 per child or per family member, whoever you're gifting it to. So a lot of times parents are thinking, okay, well, how much can I give my child for a down payment on a house, right? So we always kind of map that out. And so a father can give a son and a daughter $15,000 each. A wife can give a son and daughter $15,000 each. So there's this gifting exclusion that doesn't require an annual filing for a gift tax return. But let's say that you do gift a child, a qualifying, relative, more than $15,000. It's not that there's really any tax on it, but you do have to report that on a gift tax return to reduce the estate exemption that you have in a life, not a career basis or an annual basis, but over the course of your life. So let's say my estate exemption just for me personally is 11.58 million, and I give one of my children $500,000. Well, if I give them 500,000, it's over 15,000. And so the overage, I have to reduce my $11.58 million estate exemption by whatever that overage is by filing a gift tax return. So you just need to make sure that if you are gifting more than these annual amounts, there might be a filing requirement of a gift tax return involved in that. So talk with your tax advisor about all of that. But that 40% tax rate, that really makes me cringe. I'm sure it makes you cringe as well. So you just keep that in mind. As far as stepped up basis is concerned, this is probably one of the most important slides that I have for you today. It's to make sure that you understand that by adding children to assets before you pass, once again, up to the estate exemption amounts, you could be giving up one of the major benefits built into the Internal Revenue Code. Now, there are a lot of benefits that people can take advantage of if they know how to utilize the IRC, the Internal Revenue Code, to their benefit. One in particular with real estate, for instance, is the 1031 tax deferred exchange. It's the ability to take an investment property and trade it for another property without paying tax on the sale. Well, that's one of the top 3 benefits built into the IRC. I consider this, the stepped up basis, to be the number 1 benefit built into the Internal Revenue Code. And here's how it works. Let's say that I've acquired $3 million in real estate over the course of my life. And let's say I have one child, which I do at the moment, plan on having more, but let's say I only have one child, and let's say that I'm not married, just for ease of scenario. If I built $3 million in real estate assets for myself over my lifetime, and let's say that I'm getting towards the end of my life, if I start giving my son or adding my son to title of my properties before I've passed, my son, my heir, receives my basis in the investments. Meaning that if I had originally paid $500,000 for the real estate that's now worth $3 million, my basis while I'm still alive in those properties is $500,000. So naturally, if I sold $3 million in assets while I'm alive, I'd pay tax on the difference, $2.5 million, plus or minus depending on depreciation and other things. But let's just call it $2.5 million in capital gain. Well, that's a lot of tax if I sell it outright, right? So I'm thinking, well, why don't I just give one of the properties to my son, have him file it on his tax return, and that way he can qualify for his own financing. He can qualify for other benefits. Well, what I'm giving up at that point is this stepped up basis inheritance benefit, meaning that if I give him, let's say that my $3 million, let's say it's $1 million per property. If I give him a $1 million property and I add him to title, he inherits my basis in that property. So let's say that for that one property, I paid $200,000 for it. Now, if he ever sells it, because I gifted it to him, basically I transferred title to him. If he ever sells that under his name, his basis in the property is $200,000. If he sells it for $1 million, he pays tax on $800,000 of capital gain. And not only does that happen, but I have to file a gift tax return showing that I gave him more than the $15,000 annual exclusion. So the benefit here is to actually wait until death to transfer this asset to the child. In this particular situation, there are a million scenarios that we could go over, but I'm just giving you something that's very basic at the moment. If I wait until I die to transfer that asset through a trust, for a living trust, for instance, my son would actually, or my daughter, would inherit that property with a basis of the fair market value of that property at the time of my passing. So if I didn't give him the $1 million property, and let's say I left in death $3 million of real estate to my child, and I've passed away, my child receives a stepped up basis, meaning that at the time of my death, if the $3 million in real estate was actually worth $3 million, they could turn around and sell those properties a day, a week, a year, 5 years after my death with a basis in those properties of $3 million. Well, let's say he or she sells it a week after I die because they want to liquidate and just there's too much emotional connection to the properties and it reminds them too much of their beloved father. They could sell it for $3 million with a cost basis of $3 million, tax free. And that's both on the federal and the state side. And it's up to $11.58 million if you're single, or up to the $23+ million if you're married. So understand that the only benefit, or the only way they get that benefit, is if they inherit it in death. It's not something that I can transfer to them right away. It's something that they have to inherit, and they get that full stepped up basis. So once again, $3 million in tax-free assets that they can dispose of. What a great way to give your heirs a foot up, right? A step up on the competition. They start off with that. Now they can keep the properties, that's fine. And their basis in the property still is $3 million. So let's say that I leave them $3 million in rental property. Well, at the time that I own the property while I'm alive, my depreciable basis in the properties is only $500,000 in this example. Whereas when I leave it in death to them, they can actually restart depreciation on those properties at the stepped up basis value of $3 million. It gives them a massive, massive tax benefit as long as I don't add them to title while I am still alive. Okay. Now let's talk about something that's not that's a tax deferred asset, right? Because real estate, if I own rental property or if I have a primary residence, sure, there's the stepped up basis, but and that allows them to pay no tax on these assets. But let's say that I also have a $500,000 401k. A 401k or an IRA is money I have never paid tax on, right? So while I've gone throughout my career, I funded my 401k and I've built wealth. And let's say I have $500,000 in a 401k. Well, because I've never paid tax on it, the actual tax liability transfers to my heirs. They do not get a stepped up basis on a retirement plan, meaning that if I've never paid the tax, guess what? My heirs, when they receive it, they don't have to pay tax right away on it, but they have the ability to liquidate that asset and eventually start taking required minimum distributions at the projected year of when I am turning, or was supposed to turn, 70 and a half. So my children have to start taking an RMD at a certain point, but it really all depends on the situation. But what I'm trying to get at is that a retirement account that I've never paid tax on, the tax would eventually transfer to my heirs in death. But at that point, it's money that wasn't theirs. It's money that I've invested, that I've made, throughout my lifetime. So it's still a major benefit for my heirs. But that's one thing that does not receive the stepped up basis. Now, kind of along the same lines, if I have a stock account, not a retirement account, but let's say I just have a regular brokerage account, a brokerage account with Google and Apple and Amazon stock, let's say it's worth $500,000, but it's not a retirement account, it's just a brokerage account. The brokerage account works like real estate. So if I bought Apple stock at what, 15 bucks, let's say, if I bought Amazon stock at 15 bucks, and now I've got 500,000 in my brokerage account with basis of only, let's say, 20,000 bucks. Well, if I sell it while I'm still alive, I pay capital gain on all of that appreciation in the stock value. But much like real estate, if I leave that $500,000 brokerage account for my heirs, guess what? At the time of death, the broker has to make note of the date of death, and they give the fair market value of that stock, and they input it into the little brokerage account that I've left for my beneficiary. And guess what? My children can sell my Apple, my Amazon, my Google stock at whatever the price is at the time of my death, tax-free, up to the estate exemption of 11 point some odd billion dollars. So once again, the benefit for the children is actually in death. And I always tell my clients the reason why they're called beneficiaries is because the benefit goes to them, not to me. They're my beneficiaries. They are going to benefit from this. So just understand that some, the 401k, the IRAs, the profit sharing plans, the things that have deferred tax, they do not receive the same kind of stepped up basis benefit as real estate and brokerage accounts, other capital assets. Okay. Let's go ahead and talk about trust estates and assets for kids. Once again, I don't want to put them on assets because they give up this major benefit. Unless I am over that estate exemption. And at that point, in connection with, Ariana, for instance, a tax advisor and an estate planner would talk about the tax implications of certain things. And if we're trying to get your estate value below a certain threshold, yeah, maybe before death, there might be a reason to move assets around and shelter them differently. But once again, simply put, you don't want to start adding children to assets unless it's per the advice of an estate planner or a tax advisor. But we work side by side with estate planners to make sure that our clients don't get hit with these massive tax bills once their spouse has, or once their parent has passed. What can I gift my children each year without having to file a gift tax return? We stated $15,000 each. Anything above would reduce that lifetime gifting exclusion or the estate exemption. The most important thing that I want to touch on, and this is why I included kind of a review of the past couple slides, how often should I be updating my trust, my estate, my insurance policies? Well, annual reviews of all of that, very, very important. You want to make sure that at the end of every year or any time a major change happens with your financial situation, you always want to update the important documents that you have. So mainly the trust, the estate, and most importantly, the insurance policies. Because sometimes, we might add an asset if we acquire a property or if we acquire, a stock portfolio or if we inherit assets. Well, we want to make sure that we add those assets that we now own to our estates, to our trust, to make sure that they're protected in case anything, heaven forbid, happens to me. The insurance policy is a great example of this. Let's say that I buy, I go to Brandon, I say, Brandon, I'm ready to buy this rental property. I've got an X amount to put down. I get pre-qualified with the lender. Brandon goes out and finds me a beautiful property. And I take that property and I say, okay, well, Ariana, I bought this $500,000 home, but it needs some work. So I'm gonna work on that property over the course of the next year. So Ariana adds that $500,000 property to my trust, and my insurance company insures the $500,000 property. And over the next 4, 5, 6 to 12 months, I gut that house. I add $150,000 to $200,000 of improvements into that house, and now it's pretty much brand new. And my rent is cash flowing like crazy, and this beautiful home, and the value of the home is increasing, and I get to pull out equity and make more improvements to it. Now all of a sudden, let's say this $500,000 home is worth $1 million because of all of the improvements that I've made to it, and so on and so forth, and because of the market appreciating. Well, all of that money that I've put into the property, sure, that's great, and it's created more value for my asset. But guess what? My insurance people don't know that I made all of those improvements unless I update my insurance policy, right? So if I've dumped $150,000 into this home, and let's say that home burns down, right? My insurance company only assumes that I have the $500,000 home. They don't know about all the money I've put in because I haven't submitted receipts or proof of improvement. So much like an insurance policy needs to be updated with all of these improvements, so does a trust. Anytime you acquire new property, anytime you exchange property and maybe take one property and exchange it for 10 properties, anytime I inherit assets from a loved one, any major financial or asset change in my personal scenario, these are things that you need to update, not only with insurance, but also with the trust or the estate. It's something that could eventually lead you down a road to where some of your assets are protected by your trust, but then other assets may go to probate because you did not add those assets properly to the trust that's going to protect those assets from probate. So these are reasons and things that should spawn a conversation with Ariana and obviously with a tax advisor, and most importantly, somebody who's going to help you buy really nice real estate. So anytime you change, acquire, alter an asset of any kind, your trust, estate, trust, insurance policy should be updated. And so I gave you a couple examples there. Obviously, I could talk about examples for days, so we're not going to do that. But just make sure that any financial change, any major changes for your financial situation, you definitely want to have all of your advisors ready and available to assist. Let's talk about what's kind of currently going on right now. Obviously, we're all being impacted by this crazy pandemic. And if you or your loved ones have been impacted by any of these crazy things that have happened, this crazy pandemic, my heart goes out to you. My firm, we're sending good vibes, good energy your way, just because there's in the tax industry, and I'm sure in other industries as well, we've seen firsthand what this pandemic has done to families, to businesses, to our economy. Today, I was just looking earlier this morning at the market, saw a little bit of an uptick in value in the market. So we're seeing a little bit of momentum in a good way, moving us forward and out of this, this down economy. But not to be a negative person or anything, I just want to make sure that everybody knows that over the next year, we are going to continue, probably even longer than a year, we're going to continue to see a lot of the effects that have come about because of this pandemic. So just be patient, be aware, educate yourself about options that you have, protect yourself by talking with the right advisors, but just make sure that you know about what's going on and don't just ignore what's happening in the world. A lot of people don't want to watch the news. And I think that a certain amount of news is good here and there, but definitely talk with your advisors and figure out if you are set up in a position to where, if heaven forbid anything happens to you, a loved one gets sick because of the COVID-19 outbreak, or you get sick, or a child gets sick, just make sure that you have all of your ducks in a row. Okay. One thing in particular that I've been asked a lot about in my seminars and also with clients that I've talked to on the phone is, if I can't afford my mortgage, what are some of my options? Because I haven't been to work in 3 months. I'm not able to work. I was let go. My business shut down. What can I do to kind of relieve a little bit of the obligation I'm currently paying on my mortgage, whether it's a rental property or a primary residence? The first point of contact should be your lender. That's straight out the gate. You need to talk with your lender, because every mortgage lender, every bank is different. They're going to offer you different relief programs. Some banks are allowing people to quickly refinance or modify their loan to add the mortgage forbearance payments or the deferred payments to the backside of the loan. Some of it may impact your credit score, because obviously if they're pulling soft or hard credit pulls, it'll impact in different ways. Some people are worried that if they do the 180-day delay in mortgage payment, that at the tail end of this 180 days, they're going to have to make all 180-day mortgage payments all at once, including the accrued interest. That's very unlikely, number one. Number two, this is definitely something you want to have a discussion with your lender about. I know that US Bank reached out to me personally. I have most of my mortgages with US Bank, and they reached out to me personally and they said, hey, listen, we just wanted to double check to make sure that nothing has happened with your career. You still have your compensation coming in. And the reason why they were doing that is probably to cover their own behinds, because they're a business as well, but also to offer an added service just to make sure that their clients were in a good position and not being affected. They don't want me out of my home. They don't want me to foreclose or short sell on my properties. Banks do not want to own real estate. Let's just get that out in the open. Banks want you to have debt that you pay interest on. That's how they make money. So they want to help and assist with keeping you in your homes. Some of the smaller banks can move a little bit quicker with some of the relief plans in play. Some of the larger banks have already put into place some links on their websites that you can click and read a little bit about their relief plans. But the mortgage forbearance has been something that some of my clients, not all clients, but some of my clients have really been able to take advantage of. The first delay is 180 days. If you can't, for some reason, pay your mortgage after 180 days, they will allow for a second extension of 180 days. So up to 360 days, you can delay mortgage payment. But just remember, it's not a mortgage relief plan. You still have to pay these mortgage payments. The interest is still accruing. So each bank will be handling this differently. So definitely reach out to them and talk with them about some of the relief plans they have available for you. For the individuals who own rental properties, one of the major benefits that was built into the CARES Act is the ability to take the depreciation on your rental properties and drop it from 27 and a half years to 15 years for any improvements being made to your investment, any depreciable improvements. And what that does for rental property owners, it increases expenses for property owners that have cash flow. This is for 2019 as well. So you can go back, if you've already filed for 19, you can go back and amend 19's return to make this change. If you want to make that change in 2020, you could go ahead and do so. But this is something that you'd have a conversation with a person like myself or one of our senior preparers about, just to make sure that it makes sense to do something like that. For those of you who are veteran real estate investors, you also know that if you go back and you decrease the lifespan of depreciation, it could mean significant tax implications in the year that you dispose of that property. So you want to make sure that you also do some future planning and see if, hey, if there's less of a benefit because of the tax implication I pay 5-10 years from now when I sell this property, maybe I want to elect not to decrease my depreciation lifespan. So once again, a little bit more of a tax specific topic there, but we are available to assist and guide you through that particular part of the CARES Act. The EIDL and the PPP loans, I've been hearing from a lot of clients over the past 2-3 days that the EIDL and the PPP loans are almost gone, if not all gone. Bank of America told my client yesterday, actually, that they've stopped accepting applications for the second round of financing. Now, I'm not saying that all banks are all the wells have run dry, but each bank is specific and different. So if you work with some of the smaller banks where they were able to allocate a little bit of funding to their financial institution and apply for the SBA loans at that financial level, at a smaller bank, maybe a credit union or something, maybe they still have funds available. So once again, bank specific, just like the mortgage forbearance, you want to reach out and talk with your lender to see if they're accepting applications. Some clients have said, well, I'm not going to talk to my bank because they're not returning my calls or they're not of any help. So they go straight to the SBA website and they file applications online. I'm not going to say that they're easy to fill out. I think that because I know what they're looking for, I know how to find the information on a tax return easily and assist with clients who are looking for that information to apply for the loans. But they're pretty straightforward. A taxpayer is not going to know where to find these numbers on the return, and that's where a good tax advisor comes into play. If you need to find your net Schedule C income to show what the annual or monthly income is for your small business, boom, I know exactly what form to pull that off of. If it's a more complicated scenario where you're a corporation, you have payroll and you have employees, there's going to be a little bit more detailed breakdown of where you find that information. But if you're just kind of going cross-eyed looking at these applications, we offer free 30-minute consultations. I'll get to that in a second. But we can assist in finding those numbers on your return for you and guide you through that. We have a number of senior preparers here ready and available to help. So definitely take advantage of that. The PPP is a little bit more complicated of a calculation. The EIDL has two sectors. You can do the EIDL Advance, which is up to $1,000 per employee with a max up to $10,000, I believe, and that has not changed. The EIDL also has a regular SBA loan, which can be a much larger loan amount, but it is a payback loan. It is not a forgivable loan. The regular EIDL loan with a 3.75% interest rate, which is still a heck of a deal. The PPP loan is a little different. The Paycheck Protection Program, this actually was a loan really not meant, I'm going to go out on a limb to say really wasn't meant for single owner businesses. Single owner businesses can take advantage of the PPP, but the PPP program was really meant for businesses that had employees, like a restaurant, for instance. If a restaurant has 15 employees and because of the pandemic, you can't go and sit in a restaurant at the moment, they had to either let go of their employees, shut down their business, or just tell their employees not to come to the restaurant until the stay-at-home ordinance is lifted. The PPP program was really meant to continue or to supplement the loss of revenue to pay for the employees, right? It was meant to keep them on payroll. And if you use that PPP fund to pay for payroll, then it's forgivable, right? So if I applied for the PPP and I got, let's say, $100,000 and my monthly payroll was $50,000 a month for my employees, that $100,000 PPP loan allowed me to pay my employees for up to 2 months without me having to come out of pocket of lost revenue, right? So the PPP was really meant to supplement loss of employment revenue to pay for employment. So you need to be aware of this. If you're a single shareholder business or just a sole proprietor, sure, you can apply for the PPP loan, but as that money comes in, it's meant to supplement your loss of revenue, which is great. But guess what? You have to turn around and take that money and pay yourself a salary. You have to pay it to yourself, which means that that becomes taxable to you as compensation next year when you file for 2020. So a lot of people think that this PPP loan, it's just free money. And for the most part, at the moment, it is, because it's not income to your business. It's not taxable. And as long as you use it for certain things, the amount that you received as a business owner is tax-free. But guess what? The stipulation of that amount is that you have to turn around and pay it to yourself or pay it to your employees. At that point, your employees pay the tax on it. But if you paid yourself that money, guess what? Next year, when you file for 2020, you got to pay income tax on it. So just be aware that there is this kind of like back-end calculation that needs to be done. And I've told some of my clients this, that if you apply for that, and let's say in past years, we've been able to qualify you for certain health insurance benefits because you're under a certain income threshold, or we've been able to keep you in a bracket to where the earned income tax credit kicks in. If all of a sudden you apply for this PPP and you have to pay yourself and it puts you above that threshold in 2021 for 2020, you could, and I'm once again, very, very unique scenario, you could be dropped from a health insurance plan because you made too much. Or you could lose the earned income tax credit that we've been qualifying you for in past years because you were required to pay yourself a larger income because of this PPP loan. So just be aware that these are things that you need to take into account. This is all part of proper tax planning. And a lot of people just think they kind of eye on the prize, let's qualify for this free money. Well, yeah, it might be free this year as long as you use it for the allowable forgivable expenses. But on the back end, we don't know, because it's case by case scenario. We don't know if you're going to lose benefits next year because of qualifying for this PPP. So talk with a tax advisor. I'm not trying to confuse. I know it's confusing information, but I want to make sure that you understand that this is not something that you should navigate on your own. Okay, you should absolutely be working with a professional to map out whether or not this is a good thing for your business. If it's something that you should be applying for, in most cases it is, but in some very specific situations it might not be. So just keep that in mind. Stimulus checks, some people haven't received them yet. A lot of checks have been sent out. They weren't all sent out at the same time. A lot of fraud. I mean, I'm sure that you've heard that some stimulus checks have been sent to dead people. It's very much had this whole CARES Act has been pushed through, forced through, thought through, but only up to a certain point. And now we're starting to see some of the loss in all of this. I guarantee you that the federal government just allocates a certain percent of funds to identity theft, to fraud, to things that that aren't going to be actually received by legitimate taxpayers. So just understand that if you haven't received your stimulus check yet, you can go on the IRS website and track that. If for some reason it's showing up as non-trackable, try inputting your information in all caps locks. So silly, but once again, they push through a lot of this very quickly. And some little tweaks to your application process, if you type it in all caps, then it'll trace your stimulus check. So just be aware of that. Also be aware that there are a number of fraudulent scams and schemes being pushed through right now. I'm sure that some of you have already gotten calls about certain things. First of all, the IRS will never call you. Okay, they'll never pick up the phone and actually call you. If you are being audited and you've been assigned to an auditor, even then they shouldn't be calling you. They should be calling your tax advisor who's representing you. So just understand that when the Social Security Administration calls you, a lot of times, unless you called and reached out and talked to somebody specifically and you initiated the conversation with Social Security, yeah, maybe they'll contact you back. But the IRS will never call you. They will mail you things. They'll never fax. They'll never email anything to you. This is a perfect way for somebody to steal your identity. So just be very aware that there's more fraud out there now than there was 3-4 months ago. Just be aware of that. Okay, so be on the lookout for all of those changes and make sure once again that you have good advisors in your court. I did mention earlier that we offer free 30-minute consultations. So if I've hit a topic today that you have questions on, reach out to our office, RHA to 38470. That automatically submits your name for a free 30-minute consultation. It's not a raffle. Everybody gets this, okay? So if you know that you need advice right away, we have a number of senior preparers who are ready and available to assist in answering questions, to maybe review a 2019 tax return, make sure that all of the qualified expenses are there, make sure that you've applied for all of the necessary credits and benefits under the 2018 tax reform. And also, if you're looking for the numbers to pull off your return to qualify for the PPP or the EIDL loans, make sure that you're having a tax advisor review that and pull the correct numbers for you. I've had a lot of clients look at their gross revenue and try to apply based on their gross revenue amounts. That is not the correct number to use. You need to use the net number, which then tells you what your monthly average revenue was to apply for the loan based on the last 12 months. Or if you're going off of 2019's return, you can also use that figure as well. But yeah, this is a free 30-minute consultation. Just text RHA to 38470, and that'll automatically submit you for a free 30-minute consultation. And that's it for me. So I'm going to toss it back over to Brandon. Thank you so much for joining today. And I really look forward to hearing from all of you.
Thanks, Tony. That was great. So I know we're running a little bit over here, so let me just quickly run through mine here, and then you can reach out to us afterwards for any questions. As I said before, really this is an unprecedented time, and in the real estate market, it has affected us, indeed, but I'll kind of quickly go through how we've been affected and how everybody's adapted. Let me just go on to the next one here. So real quickly, existing home sales, single-family home sales are basically down 11.5% from February and down 6.1% from this time last year. Home prices have actually gone up, however, even though the volume has gone down by 5.6% from February and up 8.3% from this time last year. The biggest issue that we're having in the real estate market, and it's an ongoing issue, not just now with what's happening, but that the inventory is down, and it has dropped. And these are figures for last month in April. Our figures are always delayed about 2 weeks to 30 days. But we're a whole month down in inventory. And what that means is if no new properties came on the market and the current stock of housing or the current amount of housing, that quantity of housing would only last for, in this case, 2.7 months. So that is very low. Since I've been in the business, I have never seen it this low. So that's what is keeping home prices up and the market up, and what is also causing a problem with buyers expecting, oh, this should be a great time to buy. Well, they're finding that the other buyers that are out there, though in fewer numbers, everybody's competing for the little amount that is there. The one area that we are seeing a definite harder time to sell is in the luxury market, which in this area is about 2 million and above. And that market has been significantly hit, and homes are definitely taking longer in that segment. So is it a buyer's market or a seller's market? There was a Google poll done by the California Association of Realtors where consumers are finding or stating that that it is not a good time to sell. So that means that sellers, for obvious reasons, health concerns, or they're scared, are not putting their homes on the market nearly as much. So as far as the buyers are concerned, they believe slightly more that that's a good time to buy, but as compared to last year, interest rates were a whole percentage point higher. So it's, again, everybody's concerned at this point. So I think as this plays out and we start getting back to a new normal, these numbers will change. But it's just a very quick change that happened to all of us. And I think everybody in the real estate market, for the most part, kind of froze. How are mortgage rates affected? So 30-year fixed mortgage is right around 3.5, depending on what you're doing. If you're going to do a refinance, cash refinance, it will be up higher. However, the rates being low is great for a buyer, but lenders have changed their risk tolerance, and most of them have reverted back to what we call vanilla loans, where they're very they don't want to have people that have bad credit. Their debt to income guidelines have been adjusted. They basically want to make sure that whoever they're lending to right now is very easy to qualify. If you're doing anything that, if you're self-employed, if you're a business owner, trying to do stated income, or you've had some credit issues, it can be a lot more difficult and sometimes impossible to get a loan. And especially jumbo loans for the big lenders have become a lot more restrictive. Tony covered mortgage forbearance, so I don't think I really need to go over this. But again, as he stated, that's something that contact the lender, but really be sure you need it if you're requesting it, because you still do have to pay it back one way or another. As far as buying and selling property right now, homes are being sold. We have virtual tours. We have virtual open houses, social distancing protocols where we still do have showings, particularly in the Pasadena area. Showings are only 2 people from the same household at a time can see a property. Typically the agents will stay outside of the house. Nobody can touch anything, and all doors are open. So they're wearing face masks. It's all specific protocols. Paperless transactions, I've been doing that for a number of years, but it's very easy now with technology to have paperless transactions. So that relieves the need for personal face-to-face interaction as well. And then we've had a number of forms that have been created for COVID-19, where we have protection of the owner, protection of the buyer, protection of the agents, everybody involved. And we've had instances where people have gotten sick, so transactions have had to cancel, or what have you. So we have adapted, and a good savvy real estate agent will help you navigate that. But it is a time where you can still buy and sell despite all that's happening. And also, if you are struggling to make mortgage payments, definitely reach out to your lender. I do also have a free booklet that I can send to you. Just send me an email, give me a call, and I'd be glad to send this to you. This is put out by the National Association of Realtors. So this is some helpful information. But again, talk to your tax advisor, talk to your lender as well. This is my contact information, so please feel free to reach out to me if you have any real estate related questions. I work with advisors just like Tony and Ariana do, to make sure that we are part of a team to help you with your estate, with your property, to help you protect it and invest wisely. So are there any other comments or anything else that Tony or Ariana you would like to include?
Ariana, did you want to?
Yeah, no comments other than that I would encourage all the attendees to ask me questions. I'm not going to charge anyone for calling or for emailing, and it's a free 1-hour consultation when we meet. So don't hesitate to email me a question, even if it's small. I'm happy to talk to any of you and answer questions. So I encourage you to do so.
That's great. Yes, if anybody has any questions, if I'm not immediately available, which I normally am, if you have questions about taxes last year, this year, COVID-19 changes, CARES Act stuff, don't hesitate to reach out. Unless you text the RHA to the number that I provided. So.
Perfect. All right, everybody. Well, thank you, and appreciate all of your time, and look forward to chatting with our audience when they have questions.
That's great.
All righty. Thanks, everybody.
Take care.
You too. Take care. Bye.